Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. I'm going to do a video here on the S&P 500 and its valuation historically over time, going back to 1999, which as far as I go back. I promised that I would start my video in my recent article that I published, Why a 15 PE Ratio Represents Fair Value for Most but Not All Companies. But I guess in my absent-mindedness, I forgot to do it. So I'm going to post this video as a supplement for that article and the video posted in that article. I was also asked by a recent YouTube subscriber to take a look at the S&P, so I'll try to kill a couple of birds with one stone here. So what I've got on the graph here, I've got the S&P 500. I'm going to take price off for a moment. For those of you who aren't familiar with FastGraph, this is a PE ratio of 15, which I consider the standard for most companies. This, of course, is dividends. This is all the company's earnings. This is a plotting of dividends while they still belong to the company or still in the company, and this is after they've been paid out. And the bottom is the payout ratio. But this is the monthly closing stock prices. Now, for those of you who remember, 1999 and 2000 was coined by Ellen Greenspan at that time, the irrational exuberant period. This is where valuations of the market got very high, and we saw it correct back to close to this 15 PE, and then it kind of tracked that 15 PE for many years, and then starting in 2013, it's actually separated again. So I'm going to add the normal PE. Now, a lot of people don't understand what the normal PE is. It is simply a calculation, a trimmed average. The high and the low are taken out. Let me put it into English. It's trying to show what valuation the market applied most commonly over a time frame. Now, that number is clearly skewed by this high valuation here. But the normal PE is 18.3, so this blue line is 18.3. If I drop this to a 17-year graph and get rid of those high valuations, we now are at a 15 to 17 PE. The blue line now goes to 16.8. And you can see that's the fair value, which I referenced in the article I wrote and talked about in my last video. A 14 to 18 PE ratio is relatively normal for the S&P, and that's based on earnings yield. You know, of course, the 15 is your 6.67%, which I consider the standard for fair value. Now, I'm going to add another fair valuation reference using this custom. I'm going to put a 13 PE ratio here. So I want you to notice very clearly that historically the market does get, the PE of the market has gotten lower. It did that coming into the Great Recession, but it hit this 13 PE ratio for, several times over the couple of years following it. But then more recently, starting in 2013, we've had this excessive valuation. So the market is overvalued right now, clearly, but it's not necessarily as recklessly overvalued as I thought. So I'm going to keep this 16.8 in mind, and I'm going to go here and I'm going to go to the normal multiple, and here I've got 17.8, which was that higher one. So I'm going to try to find the 16.8, which I can find right here with the 15 normal. And that would mean that out to year-end 2019, calendar year-end 2019, the market would only be offering us about a 3% rate of return based on that 16.8 PE ratio. If I looked at the longer-term growth rate, analysts are forecasting an 8.5% trend line growth for the S&P. And, that would, again, if I calculate that out to this 18 PE, if it were to held this higher valuation, that would be a 7% rate of return. If it dropped to the more, I'm going to say, rational 15 PE, it would be 3.69%. But nevertheless, the market is moderately overvalued today. I'm going to go ahead and take this reference line off. The market is moderately overvalued today. I don't consider it as dangerously overvalued as some people think, but we certainly have a highly valued market right now. So the average company is not cheap today, but as I indicated in several recent articles, still are a lot of companies that you can find that are reasonably priced. In my last article, I showed FedEx as one example, but there are many others. Anyway, this has been Chuck Carnevale. I hope this gives you some insights into what the market looks like today. Thanks for watching. If you found this interesting, want to learn more about FastGraphs, either email us at the email address or call us at the phone number on the screen right now. Thanks again for watching.